Today we're going to look at estimated taxes and how you can calculate them accurately without guessing and without risk of penalties. We'll start off with a brief discussion about what estimated taxes are, then jump into using Catalyst Tax Insights to calculate your estimated taxes. If you're already acquainted with estimated taxes, feel free to jump ahead to the calculation bit. Timestamps are marked in the description below. Who needs to pay estimated taxes? Everyone does. But for most workers, your employer withholds them from your paycheck. For any income you receive otherwise, you may need to pay estimated taxes on that income, such as self-employed business income, side hustle or gig economy income, interest and dividends, taxable withdrawals from your IRA or 401k. When do I need to pay my estimated taxes? The IRS wants their tax money throughout the year. However, the tax periods do not match normal calendar quarters. For January 1st through March 31st, taxes are due on April 15th. But the next set is April 1st through May 31st, only 2 months, and is due on June 15th. Followed by June 1st to August 31st, due on September 15th, and September 1st to December 31st. You can fill out the remainder of the year, and you have until January 15th to pay any taxes owed. How do I pay my taxes? The easiest way for individuals to pay estimated taxes is to send them directly to the IRS via their direct pay portal. Business owners can also make tax payments via the EFTPS system. If you don't pay enough taxes throughout the year, you may be assessed both underpayment penalties and interest. You can avoid this by meeting the safe harbor rules. When underpayment happens, the IRS will send you an underpayment of estimated tax letter in the mail. Most tax return software will catch this and flag it as well. There are 2 ways to ensure that you do not get charged an underpayment penalty. First is to pay 90% of the taxes owed for the current tax year. For example, if you owe $10,000 in total taxes for 2026, but pay at least $9,000 in estimated taxes, you will not be charged an underpayment penalty. Option 2 is to pay 100% of last year's taxes owed, or 110% if your AGI is over $150,000. For example, if last year you owed $5,000 in taxes and had an AGI under $150,000, this year you just need to pay at least $5,000 in estimated taxes, even if your actual tax bill turns out to be double that. For high income earners over $150,000, increase that example to $5,500. Mickey Mouse files single. He makes $5,000 in interest and expects to pull in about $180,000 from his sole proprietor business. We can see the total taxes owed will be about $22,500, plus another $25,000 in self-employment taxes, for a total of about $48,000. In Q1, you can simply divide this number by 4 and estimate about $12,000 owed per quarter. Catalyst allows us to save notes on our projections, so let's record what we're paying in Q1 so it's available next time we come back. We can come back in Q2 and update with any changes. At this point, Mickey has been doing well and thinks his business may actually make $190,000 this year. We'll add a new scenario and set our business income to $190,000. At this point, we can see that our estimated taxes for the year are up to about $51,000 total, but we've already paid $12,000. Dividing that into the 3 remaining quarters is about $13,000 owed. Let's update our note. To keep it simple, let's assume when we come back in Q3, we're still at the same estimate, so we'll pay another $13,000 and add a note. In Q4, you can use Catalyst to determine the actual amount owed for the year and avoid any penalties due to guessing. Mickey finished out the year and has his near final numbers. His interest came in at $56.50 and his business income was $192,500. We can see that the final taxes came in just a little over $52,000 minus the previous 2 quarters we've already paid, and we owe about $14,000 to finish up the year. No guessing required.